Next, to the Symposium stage, please welcome Washington Trust Bank Senior Vice President, Mr. Steve Scranton. Steve is the Chief Investment Officer and Economist for Washington Trust Bank and holds a Chartered Financial Analyst designation with over 35 years of investment experience. Please give a warm BOMA, Idaho welcome to Mr. Steve Scranton.
Good afternoon, everybody. I realize that I stand between you and beverages, so we'll try and keep this short, 15 minutes at the most. I'm going to give you an economic update as to what's going on both with the U.S. and the Idaho economy. I think the main thing I would tell people is, are we going to have a soft landing? Are we going to have a recession? And I think right now what I've just told people is, this has not been a traditional economic cycle. So all the historical models that people use have not worked. They've missed those forecasts regularly. I've tried to tell people now that I think the economy is in transition. And what we don't know, are we transitioning to a soft landing or are we transitioning to a recession? And whenever you're in a transition period, you will find economic data to support arguments on either side. And that's really what's going on now. Although I would say we've seen now from the National Association of Business Economists that only 8% of them think that there's a risk of recession this year, and 92% think soft landing. I always worry when the herd's all going one way, what are we missing that might be going the other way? So I want to talk, after I give you an update, kind of how did we finish last year for Idaho and Washington? What are some of the risks we need to be thinking about that you don't want to get blindsided on? So let's start with, from my perspective, thinking about the economy. I try and give a simple explanation to people who aren't economists of saying that I always believe that the economy starts with jobs, because jobs create income. Income is the fuel that consumers use to spend, and consumer spending makes up the majority of our economic growth. It's the engine that drives our economy. So let's look and see what happened last year, starting with jobs growth. When I look at the data through December, what we see is that Idaho had 3% jobs growth. The U.S. had 2% jobs growth. So better jobs growth for Idaho overall. There's still very good business dynamics bringing people and businesses to Idaho. Idaho still has a reputation compared to maybe some of the surrounding states that this is a business-friendly state. So we move on then and say, well, if we want to continue to grow the economy, we need to continue to grow jobs so we can grow income. And there's really two sources of where you can get more workers. One would be from population growth, and the other is, more importantly, labor force growth. Because you can always have the case where you have people coming in that's growing your population, but they're retirees or they don't need to work. They're consuming your goods and services, increasing demand for those, but they're not helping fill the labor force or the open job openings. So I think first I look at the population growth. And the good news, once again, Idaho, most recent data says 1.3% growth versus the US at 0.5% growth. Then I look at the labor force and say, what about actual people that are willing to look for work? Because the labor force, by the definition of the Bureau of Labor Statistics, you're either employed or you're actively looking for work. So when we look at the labor force for Idaho, it grew 2.2% last year, and the US was 1.5%. So I think my message should be obvious by now. What I'm telling you is, Idaho saw stronger economic growth in the US, and has got that momentum going into 2024. I would say that there's the problems then that comes with growth like that. You start to have growing pains. And I think one of the first risks that I would tell you that we need to pay attention for Idaho and for other states, but especially for Idaho, Idaho's wages for employees is attractive for businesses, but lousy for employees. The average monthly earnings for Idaho, if I'm rounding, is $4,500 a month. The average for the US is $5,100 a month. And yet your expenses are pretty similar to the US. So less wages, having to deal with these higher prices that we've had, and that's creating stress for employees. And creating cases where now we have more people holding down multiple jobs, trying to meet their bills, things like that. And I think one of the biggest threats that I would say to the Idaho economy is what you heard from the first speaker. It's the housing situation in order to bring that labor in, which is going to be your capital for the future. Because when I look at, for Idaho, we've got the classic case of too much demand with people moving to Idaho, not enough supply, especially when they're looking for single family, or the others that you heard about. And what I say there, when I look at single family especially, is I just use a simple method. I take a look and say, if I take your median home price for Idaho, take current mortgage rates for a 30-year mortgage at 7%, what's the monthly mortgage payment? Then I say, how much of that mortgage payment, how much of the paycheck is consumed by that mortgage payment? So if you had a couple that wanted to rely on one income to buy a house, for the US it takes up 51% of that paycheck. For Idaho, 62%. So what that says is you have to have two incomes to buy a house in Idaho. And that's fine as long as the economy is going well and everything's going fine. But when you're talking about your shelter, not your investment, because I try and tell people over and over again, when you're living in your house, that is not an investment, that is your shelter, no matter what Zillow may tell you about your home price. So what I say is, well, if one of those jobs is in jeopardy, either hours get cut or they lose the job, suddenly you're at risk of losing your shelter. And we actually have there's a name that they've said for these type of people. It's either individuals or a family. It's called an ALICE family. Asset limited, income constrained, employed. So we have working couples in many cities and situations that have either had to move in with their parents again, or they are actually homeless, even though both couples are working. That is not a situation you want to have developing for a city. And the real problem for any city, and especially for Idaho as a whole, a state, not just a city, but for the state, is that businesses may look and say, hey, Idaho is a great place to come, I love their wages. And then when they come to do their due diligence, it's going, whoa, wait a minute, my employees can't afford to live here. They'd be living all the way, as we're seeing now, we've gone past Caldwell and now we're north to Emmett, just to find livable places for people, and people saying, I don't want to do that. So I think long-term the threat is, if you're viewed as unaffordable, great place to live, but you can't afford to live there, businesses are going to be businesses and say, well, where's the cheaper place? And what we've seen so far over the last 5 years is this migration from both coasts moving inwards. So we crossed the Washington border, now we're into Idaho because it was attractive. Now we've made Idaho unaffordable to live, and the danger is, do you stagnate your growth then? And especially when we don't have a cooperative process where we need to have the partnership between government, builders, and neighborhoods saying we need more styles of living, as you heard earlier today, and not to be fighting that, not to have that NIMBY mentality of no, not in my backyard. So I think that is going to be one of the threats for Idaho overall, and that would affect demand for commercial real estate or anything else. That's not the situation right now, but this is what I'm saying. You need to be thinking ahead. How do we deal with it now while times are good, rather than waiting for it to become a severe problem and trying to stop that momentum? Another threat I think we have to look at, people ask me all the time, what's going on with interest rates? Are we going to finally see interest rates coming down this year? And I just continue to say, look, believe what the Fed tells you, not what the bond market tells you. And the Fed has been very clear. I think Chairman Powell couldn't have been clearer. He said both in his press conference after the last meeting, and then he chose to go on to 60 Minutes to deliver the message even clearer. We are holding rates higher for longer until we see inflation coming down towards 2% and then sustainable at 2%. And we are not there yet, and we are not going to be cutting rates in the first quarter like the bond market thought. He's indicated the Federal Reserve still believes this year as a whole that they will reach the point where they will lower interest rates by 0.75%. I continue to say that is all contingent on inflation continuing to come down. And as you heard from the panel, we saw the CPI report this morning. Inflation actually ticked up a little. I would just remind people the Fed doesn't look at CPI. They look at a different inflation index called PCE. It was at 2.9% in December. We'll get its January number later this month. But we've got to see that progress coming down. Because if we don't, the question that I just throw out to people is, look, maybe you need to think outside the box. What if these current rates are an actual neutral rate? Because we had the Fed get to this rate July of last year. So for 7 months they've been here, and the economy continued to grow above 3%. So I think that is just something we need to think about, is what if this is actually the neutral rate and the Fed's not going to lower rates until either they see the economy starting to have problems and slow down, or inflation truly come down towards that 2% level. So focus on inflation if you're wondering what's going to go on from the Fed standpoint. So I think that's the general quick picture I would give you for the economy. What I would say is that when we look at historically for where interest rates are, if I look at two time periods, 1973 to 1983, where we had the big, huge spike in inflation, I pull that out. I look at 2009 to 2019, where we had artificially suppressed almost 0% interest rates. I pull that out, say those were anomalies. We are right in the range where rates have been historically. So when people are saying, oh my God, these rates are so high, my answer is you must be less than 30 years old or 40 years old. Because these are not necessarily high, and I think what we're going to see, including commercial real estate, but other businesses as well, those who built a business plan, assuming they would continue to see those low interest rates, are probably going to be in trouble. But those who have a solid business plan, solid financials, thought ahead of, well, what if they don't stay here forever? They will be the ones who will see the opportunities of either defaulted commercial real estate, bankrupt businesses, those types of things. I've always said, out of challenges or crisis, I think more of a challenge than anything right now, comes opportunities. And I think it'll be a natural weeding out process. There are businesses that probably shouldn't have formed and shouldn't have stayed open, except for the fact that rates were so low and they could keep rolling their debt. Same for commercial real estate. We're going to wash those players out, and I think we'll be left with a stronger foundation with well-run businesses looking for those opportunities. I can tell you, I hear over and over again when I talk with our developers in Idaho and the other markets we're in, investors have cash. They're all smiling and saying, we're going to get some great deals. And owners have said, not at these prices, I'm not selling. Well, we're playing a game of chicken, and somewhere we're going to see something break. And I think it may well be the case of that debt coming due, and then the investors having a chance to invest there. So I just want to leave you with a few takeaways or challenges for you. The major challenge I would give you is to tell you to believe what you see going around you, not what the media is telling you, especially social media. If your business is doing fine, you're seeing things fine, stick with what you're doing. That's the second point I'd make is stick with what's working. Don't make changes if it's not broken. The old, if it ain't broke, don't fix it. Because the worst thing you want to do, not to pick on one college, but the worst thing you want to be is Colorado last year, who had a 29-point lead in football at halftime, went to a different game plan of let's protect that lead. They got complacent, they figured it was in the bag, and they lost that game. So if you get complacent and believe everybody telling you we're going to have a soft landing, don't worry about it, and you're not thinking, what if that's wrong? You may be surprised then. So my third case to you is to say, have a plan now. While times are good is the time to build for when times are going to be bad. Because recessions are part of a normal business cycle. We will have bad times, whether it's 3 months from now, 3 years from now, or whenever. But if you build out a game plan of saying, here's how I'm going to respond when that happens, then you respond objectively, and you can keep your head up and look for the opportunities. If you say instead, everything's fine, I'll worry about that later, and suddenly you get surprised because everything wasn't fine, you're going to be one of those opportunities that somebody else is going to take advantage of. So I think for now, enjoy the strength we're seeing, make plans for what will change if the economy starts to weaken, and look forward to opportunities as they come. Thanks, everybody.